evening. You've got more than money. You've got Gene Dickinson, your host, your personal financial advisor. Happy to be with you. Happy to be with you for the next half an hour or so as we serve you in every way that we are able. If you're a loyal viewer to More Than Money, you know exactly how this works. I'll give you a little bit of an intro, kind of set the stage, kind of maybe an appetizer. Okay, I'm already thinking about Thanksgiving dinner. My apologies. Hey, food, it's a good thing. Bottom line is we get you all squared away, and then we answer questions that you have sent to us via email, gene@askmtm.com. It is an absolute honor to be able to do exactly that. I mentioned Thanksgiving dinner. For many of you, as you're watching this, a couple days from now, you'll be, by this time in the evening, out like a light at after dinner nap, sounding so wonderful, or some football maybe, but most importantly, the term is Thanksgiving. And hopefully you are more than engaged in the whole process of giving thanks, in the whole process of feeling the gratitude for so much good. Yes, lots to be seen if you look around for reasons to be annoyed, reasons to be concerned, reasons to be unhappy. And there's probably 10 times that many reasons to be thankful, to be grateful. And perhaps it starts with families, folks that you love. Perhaps it starts with your ability to help other folks. Perhaps it's somebody who has helped you. And perhaps it is a gratitude that's far bigger than all of that. But bottom line is that it's a well-known, well-documented, scientifically proven fact that folks that have gratitude in their lives, that feel thankful in their lives, they live longer, they are happier, and they are healthier. Somehow, that feeling of gratitude has all of that positive impact. So if that's not your go-to, maybe give it a try. Maybe see where that takes you. Maybe spend a few moments, maybe just by yourself, and maybe pen in hand say, what are some of the things I'm grateful for? And maybe on that list will be more than money. Who knows? That would be fantastic. We've had a chance to meet so very many of you as you've come through our offices, and that's, what a joy it has been. And one of the things I am most grateful for this year and every year is you. You have allowed us to become the most relevant financial show on television today, coast to coast and border to border on any station, because it's all about you. You set the agenda. We give you the benefit, perhaps, of our 780 years of experience. You put those two things together, and it makes for, apparently, a rather remarkable show. So back from her being away from us on assignment is our financial correspondent. So let's start our show with our first question from Megan. Megan, welcome back.
Hi, it's good to be back. I missed being here. Our first email tonight says, my wife and I are 73 and 74 and retired with about $1 million in IRAs. We've been slowly converting from traditional IRAs to Roth IRAs and, of course, paying RMDs. I'm the one who has been handling the investing over the years, mostly in ETFs, but my memory and skills are slowing down as I get older. I'm wondering about checking out various robo services. I'm sort of leaning against doing this, but what are your thoughts? We've been watching More Than Money for about a year now and certainly have learned things from you, so thanks.
Well, you're very kind, and again, we are grateful for your questions. For a lot of folks, the question is, do robots make good financial advisors? It's a confusing one. They didn't know that there were robot financial advisors. Now, they're not called robots because that's not kind of a marketing a word that works well, that gives people peace of mind. It's kind of spooky, actually. Robo-advisors, that sounds so much nicer. So much nicer. Lots of you are not aware that robo-advisors exist. They do indeed. They came a cropper 4 or 5 years ago. There was a great huzzah about the evolution of this advisory industry turning into automated and computer driven, and we don't need people anymore. That's silliness. We are far more technologically advanced than that. And yet, that huzzah has kind of faded away to just a kind of a buzz in the background, because robo-advisors do one thing very, very simply. They manage investments to a certain direction. And that's all that they do. So in this gentleman's case, for example, he talked right away about doing Roth conversions. And without going into detail, most of you are familiar with the term, without going into detail of the mechanics, the question about whether he should be doing Roth conversions or not would certainly be one he would discuss with his financial advisor. But a robo-advisor has no opinion on that. A robo-advisor really isn't. It's a robo-manager. It is fill out a form, give them some idea of what you think you should be doing, and let the computer do its thing. Whether you have a question about should I be doing Roth conversions, or what would be the tax impact on me if I did a major Roth conversion, or what impact would it have on my Medicare premiums through IRMA, all of those questions perfectly appropriate for a financial advisory relationship, they don't exist with a robo-advisor. So for someone who has been actively involved, he's 73, he's 27 years away from his Happy Healthy 100 celebration, part of our Triple H Club. He's got lots of experience. He's needed to make decisions about taxes, about estate planning, about insurances, none of which would have been assisted by a robo-advisor. This is not for you, in my opinion. I think you would do far better to work with a human being and have those kind of conversations that only people can have back and forth. Are there certain circumstances where robo-advisors make sense? Yes, if you're relatively young, you have relatively small amount of money to invest, and you have little or no interest in how the investments are done yourself, robo-advisor may make sense for you. In this particular case, I would say, no thank you. Makes great start, very interesting. Lots of folks out there going, robo, never heard of that. Is there something else, something new we might be able to add to our next question?
Well, our next email also comes from another person who's been handling their finances by themselves. They said, we enjoy watching your show. A past show indicated I could transfer index funds into ETF alternatives without tax consequences. As a 50-plus-year-old individual self-directed investor, I have acquired almost $1 million in index funds, which are not ETFs. My own personal year-end review indicates that their annual returns are nearly identical. Would the supposed tax savings of ETFs warrant this transfer, and how much would I actually save? Annual adjusted income approximately $220,000. Thanks for your advice.
Well, you're quite welcome. Thank you for the question. And the title that we've created here, The Devil and the Taxes, are in the details. Details matter. In basically everything in life, details matter. In this particular case, the detail that's missing, or the detail that's been misinterpreted, let's use that as our label, is the fact that this gentleman believes that he heard someone, myself, say that he has $1 million in indexed mutual funds and that he can convert those into exchange-traded funds with no tax consequences. And that's not true. That's not true at all. So the premise here is that he could go from a significant block of capital in mutual funds into something totally different. Exchange-traded funds, they sound so similar, but they're not. That he could go from one to the other without paying taxes along the way. And the answer is that's not true. If he went from mutual funds to real estate, he would pay taxes. Mutual funds to putting money into a pension fund, he would pay taxes. So liquidating his mutual funds will cause capital gains, perhaps significant capital gains if he's been successful for many, many years. Not likely in his best interest. Not likely. Now, there are situations where maybe it is in his best interest. People go, well, how can it be in his best interest to pay taxes he doesn't have to? What if his mutual funds, with lots of gains, lots of profits, cause him anxiety now that he has come a bit further down the path and he is, successful in accumulating these dollars? Now perhaps his worry is, what happens if there's a dip in the market? What happens if the stock market slides? What happens if there's a 50% loss? Is there a way to be protected? The answer is yes, but you must move from where you are to a different type of investment. And that might be worth paying the tax. In general, this is not a decision that can be made without knowing exactly how much tax there will be, exactly the tax bracket this gentleman finds himself in. It is unwise to make that move or even consider that move without knowing in advance exactly what that impact would be on your 1040 in a subsequent year as you file. So the final question, which becomes moot, or as my friend Joy would say, it's a moo point, is whether or not being in ETFs with their tax advantages would offset some of his concern about moving from mutual funds. The ETFs have significant tax advantages, but that means nothing to us until we've determined that we should make the move at all. So, are there ways to protect investments? Of course. Are there ways to move from one investment type to another? Of course. Do they usually involve taxes? Of course. Be very, very careful. Make sure you're working with a trusted, experienced financial advisor who also has both the ability, permission, and the skill to give you good tax advice along the way. Outstanding. Very, very interesting indeed. Megan, where do we go next?
Well, moving from taxes, but sticking with mutual funds, our next question says we are downsizing in September. The house we are considering is $330,000. Our house is priced at about $430,000. Our house has good bones but needs minor repairs. For someone who can do the repairs themselves, it would be inexpensive, but if I have to pay someone to do the repairs, the cost of labor would make it expensive for us. I have received a cash offer from a flipper for $369,900. I'm so sorry. I am tempted to take it so I won't have to do the repairs, but what do you think? If we could sell the house quickly, it would pay for the next house. But if the house doesn't sell quickly, we have $412,000 in a mutual fund that would cover the cost of the next house, but the mutual fund is performing very well right now. Wondering, would it be a good idea to withdraw these funds when they are performing so profitably? If we invest the funds from the sale of the house in the same mutual fund, would it continue to earn at a high rate? Thanks for your answers.
Well, don't thank me yet. Some of the answers are going to be very straightforward. Some of them are going to be a bit of a head scratcher, so let's reserve our gratitude. See, there's a theme for the show until we have wrapped this a bit. Downsizing, very common. 20 years ago, you went from a 4-bedroom, 2.5-bath center hall colonial to a 3-bedroom, 1.5-bath rancher. You would sell your home for $500,000. You'd buy the new home for $250,000. You'd have a lot of money in the bank. Life is grand. These days, the types of houses that baby boomers are downsizing to are every bit as expensive as the home they are selling. So it is not uncommon at all to downsize and it costs you money out of pocket. Now, that's not necessarily the case here. They have identified a home, $330,000. Their home is currently, or at least in some way, shape, or form, estimated to be worth $430,000, but they've received an offer from a flipper that is $60,000 less than what they believe their home is worth because their home needs some repairs. $60,000 would cover a lot of repairs. So while I absolutely understand their concern about being able to do the repairs themselves, that it would be expensive. Well, if someone could do it on their own inexpensively, then even if it were very expensive, it might be $10 or $15 or $20,000. Let's say $20,000 to buff the place up. All of a sudden, giving up $60,000 to save 20, that makes no sense. At the very least, you should have someone that you trust go through your home, show them what needs to be done, and get an estimate of the cost. You may be pleasantly surprised to find that it's not that difficult, it's not that expensive, and in many ways it could be to your advantage. So let's put that aside for the moment. If your home sells quickly, you have the opportunity to buy the new home basically with cash because you have proceeds from your current home. But your concern is, what if it doesn't? What if it doesn't? Well, there are a couple things to keep in mind that you might find useful. The first is there are programs, there are certain real estate brokers throughout the country that have programs where they will buy your home and allow you to stay there for a certain period of time, typically a month or 2 or 3, a relatively short period of time. So you sell your home, you have your cash in hand, you buy your new home, you have time to settle on that new home, perhaps a month, 6 weeks, in order to get everything in order to settle, and then you move from your current home. So that's one option that you might want to consider. A second option that you might want to consider is the use of a reverse mortgage. Reverse mortgages are very often advertised, particularly on financial shows, but bottom line, for many of you, a reverse mortgage still remains a mystery. And for some of you, a reverse mortgage is something that you should become educated about. Whether you're downsizing and buying a new home, that's available. A reverse mortgage is available to do that. Or whether you're staying in your home and you want to pull some of the equity out without needing to make monthly mortgage payments. That's one of the beauties of reverse mortgages. Lots of details, devil's in the details. We've already covered that. But bottom line is that if you have these at least 2 options, you might be able to avoid the third option. The third option is your mutual funds. If you've got mutual funds that have done well, that means that probably you've got some embedded capital gains, and in order to get that money out and help you with the new home, you would have to pay tax on those gains. And if we can avoid doing that, we would like to do so. One way you might avoid doing that, but again, it needs to be explored to see if it fits your situation, is using that block of mutual funds and the equity in your home as collateral for a short-term loan. A collateral, in this case, over $800,000 collateral in order to borrow the $330,000 you need to buy your new home, and have a short term, hopefully less than 6 months by the time your current home sells and the loan is paid off, but a relatively short term, even if you're at current rates 7 or 8% a year, if you're only going to have it for 6 months, you'll end up borrowing the money, paying 4% for 6 months, 4% actual rate of return or rate of interest, and in this case, about $14,000 of cost to get from point A to point B, but you pay no tax. So lots of different options. Which one is best for you? Your email certainly doesn't give us enough details to tell you that, but it does give us enough details to tell you that what you really need is to sit with someone you trust who has experience across all of these types of strategies, and it'll take less than 2 hours to compare all these options and pick the one that's best for you. Good luck with that. Circle back. Let us know how you make out and how that new home goes for you. Megs, what's next?
Well, our next question, the viewers want to know if they can help out their grandchildren with college. This one says, I've managed our investments and done pretty well, I think. But now I've run into something that confuses me. My wife inherited an IRA from her mom last year. We haven't taken anything out, and everything I read says we should leave it in as long as possible, 10 years, I guess. But we have 3 grandchildren, our daughter's children, in college, and that's putting quite a burden on their family. My wife is asking why we just don't take the money out over the next 3 years and pay down or off their college. From my reading, I'm not even sure that's allowed, but I guess I finally need some help. So thank you in advance.
Well, you're very welcome in advance. Again, gratitude. Is my wife thinking straight? I've been on air, radio and television for well over 30 years now. I added it up once. I think I've done something in excess of 4,000 shows. I have probably fielded hundreds of questions where husbands and wives have a difference of opinion. Not a disagreement, difference of opinion. And the question is, who's right, husband or wife? And as a married man myself, the answer is quite obvious. The wife is always right. Get used to it, buddy. Suck it up, buttercup. Here's the issue. Not only is that a good rule of thumb in general to be correct about 98% of the time, in this particular case, your wife is very right. She is very right. From your reading, you've been introduced, and that's the correct word. You've been introduced to the idea of the 10-year rule. When your wife inherited the IRA from her mom, the clock began, the timer started on a 10-year run, and the IRS says by the end of 10 years, that money's got to come out. There have been some confusion. There has been confusion from day one, January 1st of 2020, when this rule theoretically went into effect, that whether can you wait until 9 years and 364 days? Must you take something out each year for 10 years? Is there a minimum, et cetera, et cetera? The IRS has caused so much confusion that to date, as we are nearly celebrating Thanksgiving in 2024, 4 years have gone by, they have said, don't take any money out if you don't have to, because we don't know what our rules really mean, and you're not required to. Even though it says you're supposed to, you don't have to. So lots of confusion. There's certainly a 10-year rule, but the 10-year is the maximum you can go under some set of circumstances. It is not a restriction. It doesn't mean you can't come out earlier. That money can't come out more quickly. Your wife is suggesting that the money come out more quickly, not 10 years, but over 3 years. And she's suggesting to do that in order to help her grandchildren, which would thereby also help your daughter. Indeed, it would also connect your wife's mom to your wife's grandchildren. That connection, that benefit, that goodness, link is a beautiful thing. And I am suggesting to you that while there may be financial reasons, plus or minus, if we take it out a little longer, do we gain a little more? Maybe. If we take it out now, do we maybe lose some tax benefits? Maybe. And my gut says, so what? This, the timing of this, the loss of her mom, the need of her daughter and your grandchildren, 3, having recently become a grandfather myself, the love and joy is unbelievable. The connection that your wife sees between the generations, I think, is clear as a bell. And I think your wife's instincts are so spot on that you need to get on board. You need to get on board. Now, kind of the last line of your email was like, she wants to take it out early, and I don't even know if that's allowed. The answer is, of course it's allowed. Yes, it's allowed. If you have any concern whatsoever, I'm here to put those concerns to rest, because just like required minimum distributions coming out of IRAs, people go, I'm 73 and I have to take, I need my RMD and it's $21,000. I wish I could take 24, but it's 21. Whoa, required minimum distribution. The IRS is saying on an inherited IRA, you've got 10 years, but there's no restriction. There's no prevention, nothing preventing you from taking it out earlier and paying the tax earlier. Yeah, we get that. We understand that. The IRS understands that. So no, they have no objection whatsoever. So doing this in this way, and for many of you who have inherited IRAs throughout the years, particularly the last 2 or 3, this how best to get the money from the inherited IRA to something valuable or worthwhile. If it's to benefit you, maybe you move it from the inherited IRA into a 401k contribution, a Roth IRA contribution. There's lots of different things that you might do for yourself. This is very different. And in my opinion, it's a humble opinion. It's not humble at all, but it's my opinion. I think your wife is so spot on. I think her instincts are fantastic. I think the generational connections are magnificent. Timing couldn't be better. Get on board, support her with a smile, not just with a smile, be joyous. Be thankful that this opportunity came for you and your wife to make an impact on your family that will be felt for generations, absolutely felt for generations. I know I've maybe gone a bit too verbose, a bit too wordy, but I'm hopeful that some of my words have convinced you that not only is your wife thinking straight, she's brilliant. She's brilliant. Folks, thank you so much for spending part of your evening with us. Half an hour goes so very quickly. We cover as much ground as we can, but sometimes Gene goes to the soapbox. If you would be willing to risk having your question being answered by a gentleman on the soapbox, that would be a blessing to us. Send us your emails, gene@askmtm.com. We answer every single email back to you. Some appear on future shows. We don't have time to do all of them, of course, but every single one, we have a tremendous team of advisors that are willing to take the time to help you. There's no cost, there's no obligation. It's just our opportunity to serve you and your opportunity to keep us the most relevant financial show on television. Thank you again, and hopefully you'll return next week when we're back with another edition of More Than Money. Good night.